Bhafnaji, please continue.
Yeah, welcome this Rajesh Mody on this our website series and on webinar. This accounting standard of the cash flow statement and all the foreign exchanges AS-21 on all the today to our viewers. Most welcome this Rajesh Mody on our platform. I am TC Bapna, the President Jain Chartered Account Federation, New Bombay. Welcome again. Let us introduce by Jainam Shah of this Rajesh Mody ji and all. Okay, thank you.
Thank you, sir.
Thank you, sir. So, CA Rajesh Mody, sir, is practicing chartered accountant in the field of assurance advisory. He is presently associated with CNK and Associate LLP as a Director Statutory Audit. He was a partner of Messrs. Rajesh Shah and Company, a Mumbai-based 3-decade-old firm located at Fort. He was heading the assurance business advisory division in the firm. CA Rajesh Mody has over 25 years plus experience in areas of assurance practice, internal audit, business advisory. His audit and assurance clients include public limited company, private limited company, multinational Indian firms, NBFC, many more. He has over a decade experience in handling internal audit of clients in manufacturing industry, diamond export and real estate sector. Sir has a hand-on experience on advising client of phase 1 companies in Ind AS implementation and is advising phase 2 companies on Ind AS implementation. He has addressed members and students in the area of accounting standard, auditing standard and Ind AS. Sir is a regular speaker at study circle study group for Ind AS topics. Sir is highly rated faculty for IFRS certificate course conducted by our institute ICAI. He is a subject audit editor on financial reporting for Walters and Clout CCH. He has trained credit appraisal officer of SEBI and Exim Bank on IFRS subject. Sir is the convener of Accounting and Assurance Committee of BCAS for 2018-19 and a core group member. He is the convener of IFRS Study Circle of BCAS for 18-19. Sir is empaneled as a technical reviewer with FRRB of ICAI. Sir is the coordinator of IFRS Study Circle of WRC ICAI Mumbai for 2 years. Sir was instrumental in forming the IFRS study group, first of its kind in India. The study group is awarded Certificate of Appreciation for 2 years in a row since formation in 2015. Sir's areas of expertise include IndAS implementation, advising as a leader to oversee, supervise, guide, train the staff of CA firm and client in successfully transforming from previous GAAP to Ind AS. Sir has successfully handled the team of first phase implementation and second phase implementation in India in listed companies. The sector cover are infotech, manufacturing, commodity trader. Sir has advised the client in diamond manufacturing and export sector on IFRS conversion for the purpose of site holder status with diamond mining companies. Study of internal control system, designing of MIS for management, software viability study and implementing system design, preparation of SOP, conducting diagnostic audits, due diligence for acquisition joint venture, carrying out cost reduction, carrying out valuation of business for share transfer under FEMA laws. Sir has a training passion as a training and grooming the next generation on positive attitude, how to face adverse situation in any aspect of life, auditing, accounting standard and Ind AS standard. With this introduction, I would like to request Rajesh sir to take the charge of the session and start the session, sir.
Okay. Thank you, Virat, thank you, Bhafna ji. It was nice hearing about you. And thanks for the detailed introduction given to me by Virat. So friends, good evening, everybody.
Good evening.
As I'm Rajesh Mody, and unfortunately, few days back, my laptop went some problem was there in my laptop. Some virus has gone in. So because of that, I will not be visible to you. I am through my assistant. He is actually sharing the slides, and I am actually as a panelist. I have come here. Okay. So for that, please bear with me. So now let us begin. I will be there with you for 2 days, today and tomorrow. Today we are covering two topics. Tomorrow we'll be covering another two important topics. First, we will be covering today that small one, statement of cash flows. However, it is not that small. Actually, it is very, very relevant and important topic, specifically when we are passing through this COVID-19 impact. Because here always the cash will be the king. That's why all those entities who are having a sufficient cash on hand, or they are able to manage liquidity during this period, they are the entities who will survive this, and they are the entities who will then take the opportunity to grow in the future. So in that sense, truly speaking, we will find that cash is the king at present. So that way it is very timely topic, I would say. It is matching with this environment also. So we will be covering first statement of cash flows, and then another very, very important topic, that is Ind AS-21, effects of changes in foreign exchange rates. So these are the two topics for me today to be covered in the next 2 hours, and I will try that I do justice to that, and that whatever faith you all have put on me, the organizers, I will be able to stand for that. Thank you. So now let us begin. So friends, as I said, statement of cash flows, that is Ind AS-1. Why it is relevant? Because why we need cash flow? First of all, we have to go back to the basics of accounting. If you see, there is a framework in our Ind AS regime. That framework actually defines what is elements of my balance sheet, components of my financial statement, and in that case, if you say elements, they are defining as what is the asset, what is the liability, what is the income, what is expenses, what is equity. Everything is defined there. So first of all, any item has to be your falling into the definition of asset, liability, income, expenses, or equity. Once that you are able to fulfill that, whatever transactions you have carried out falls under any of these 5 elements, then the question is of recognition. So again, the framework defines when you will be able to recognize is whenever there is a probability of future earnings out of that, right? So future benefits should flow to the entity either inside or outside, and the cost can be measured reliability. If these two conditions are fulfilled, then only any of those elements in which the entity has entered into can be recognized in the financial statement. Now, what is the components of financial statement? Again, Ind AS-1, I think, which is what you have covered in the first day itself. Ind AS-1 defines components as all my items of balance sheet, like balance sheet, profit and loss, cash flow, SOCI, that is statement of changes in equity, notes, etc., etc., etc. So again, here one of the component they are defining is as statement of cash flow. So if any investor has to take a call, take a decision whether to invest in that particular company or not, whether to exit the company or not, for that he will have to go through all these 3 components which are very important, right? Balance sheet, P&L, cash flow statement. Taking all these 3 things together, we will be able to find out, okay, how is the company growing, whether it has sufficient cash flows, whether it is investing in the operating activities or not, whether operating plants and machineries, everything, they are able to maintain it properly or not. Out of that, whether they have plans to expand or not, because these things are very, very, it is not important that today the company is earning good, but what about tomorrow? One has to look for long term, maybe 5-10 years henceforth, what will happen, in which direction the company is growing. Second thing, the cash flow will throw light on how the management is able to manage the cash flows. So at the end of this, if you will find, I have taken 3 types of various industry examples in which you will be able to understand that how management is managing those cash flows. So it is important that management with whom the investor says put faith to manage the business, to manage the resources, whether how they are effectively utilizing those resources or they are actually wasting those resources. So if management is wasting those resources, then the investors can force the management either to give back those cash, so that investors are capable to take decision where to deploy those cash. So that's why we will find that many companies actually come out with dividends, many companies come out with buyback of shares, because they feel that they don't need that much cash, because they don't have that avenues to invest those cash and grow at a rate which can be higher than what the investors can get from investing anywhere else. So if that is the case, then management takes the call, and that is, I think, the best strategy, that if I am not able to manage it properly, better it to give it back to the investors. Let them decide what they want to do with their cash, but at least that should not lie idle with the entity. I think this is how, and this is where cash flow statements helps analyze any investor, how the management is doing about the scarce resources, and what is the future of the entity, and what is the right time to liquidate the investment. I think this is where cash flow along with other components of financial statement helps. So let us start. So as I said, now coming to your cash flow, as we all understand, what is cash flows? Cash flows are actually the resources which is in the hard cash, or which the entity is able to generate out of investing into business and by way of profits, and which is ultimately converted into realizables, that becomes cash. So there is inflow of cash and cash equivalent. We will see what is the definition of cash and cash equivalents, but first thing is, one side there is an inflow, and that inflow has to be properly utilized into the business, so it becomes outflow of cash and cash equivalent. So we will be covering these two parts, which is very, very important. Now before we go to the next thing, let us now compare, take the definitions. Now what is cash, my friends? Cash comprises of cash on hand and demand deposit. Now what is the meaning of demand deposits? Actually these are all bank balances. We have different kinds of saving bank, current account, so all these comes under demand deposits, and maybe very short term 3 months ke niche wala jo rehta hai deposit, that also can be covered. Now cash equivalent, they are covering cash as well as cash equivalent. What is the meaning of cash equivalent? It is like almost in the nature of cash only, but it is not exactly cash. So how the standard defines cash equivalents? Actually they are saying there should be 3 conditions which needs to be fulfilled to be eligible for cash equivalent. That is, they are short term, highly liquid investments. So here important is it should be short term, so it cannot be your long term investment. It has to be very short term, it should be highly liquid, and which can be easily convertible into cash anytime, and most important, which are subject to an insignificant risk of changes in value. So here what they are defining is that it is almost like cash. So I should know that suppose I am investing for 3 months, at the end of 3 months I should be knowing how much exactly I am going to get. So that is, they call it as there should be insignificant risk of changes in value. Value should not be a risk factor. I should be able to determine my value. And second thing, another important thing is that I am investing this so that maybe in the short term I will be able to get back those funds when I actually need for actually outflows. So meet my liabilities, meet my commitments. So that is another most important point which you have to consider, that there should be some commitment for which I will need that funds, but temporarily, because I don't need, I am putting it in a highly liquid asset for temporary very short term period, and that asset should be such that anytime I can be able to liquidate, and there should not be any significant risk of change in value. That is most important thing. So mostly we go by that. If you see, you will find that FDs and all those things we keep, because they are all very short term and liquid, and I know exactly after 3 months or something how much I'm going to exactly get. There is no risk of change in value. So this is actually very, very important point which needs to be considered. Now, so again, I have said cash equivalents are held for the purpose of meeting short-term commitments. So if you don't have any requirement of your fund, suppose, then even though it may be you are fulfilling other conditions, but purpose for which you are investing has to be to meet the short-term cash commitments of the firm. If you are not fulfilling that, then again may not be a part of cash and cash equivalent. So this all three things you have to take it together to decide whether a particular component has to be included as a part of cash equivalent or it should be my investment activity. This is very important. So now, friends, let us see few examples. What can be my cash equivalent? So first one, it is redeemable preference share held in an entity. Here, what is most important is that it is not like that after 3 years it is going to be redeemed. Here in this example, we have to see to be part of cash equivalent. That maturity of that should be less than 3 months, because that is what they are, because then it becomes short term. So if I'm investing into any entity's redeemable preference shares with a maturity date within 3 months now, then because in redeemable preferences I know exactly what is the amount I'm going to get, so I am able to fulfill those conditions of cash equivalent. So in this case, we can include such type of instrument as a part of cash equivalent. Next example, bank overdraft. Friends, as this is the main difference between AS3, which is our IGAP standard, and Ind AS-1, which is our IndAS standard. In AS means existing gap, they are saying bank overdraft is not part of your yeah. Am I audible now? Hello.
Yes, yes.
Yeah. Okay. There was some connection problem, that's why I thought fine. So and now takes another example as crash credit. As the word itself says, it's a funding facility, and so normally it will go on as on a long-term basis. It is not like demand deposits unless there is some breach. So wherever there is a breach, they can demand the loan. Otherwise, it is ongoing basis. CC will go on. So that's why CC is not to be covered as a cash equivalent, but at bank overdraft by nature it is demand deposit, and it is only used when it is required. And the balance always fluctuates between positive and negative, and that's why under Ind AS-1 specifically, bank overdraft is considered as a part of your cash equivalent, not under IGAP. Third example can be units in mutual fund. Generally, mutual fund, if it is an equity investment, we never consider it as a cash, because there we don't have any guarantee on the value, change in the value, because standard says that cash equivalent has to be, there should be an insignificant risk of changes in value. But here, that's why I'm saying debts. So any mutual fund, it is only in the debt mutual fund, maybe, and again it is should be short term. Then we can say if it is fulfilling that condition, that there won't be, I should be able to determine the value at the maturity what I am going to get or when I am going to dispose it. If there is no likelihood of very insignificant change, then only I can cover cash equivalent. But generally, units in mutual fund, if it is equity invested, it will never fulfill this criteria, and it cannot be considered as a cash equivalent. Next, having taken few examples of what is my cash and cash equivalent, now let us see the purpose of my cash flow. So what it depicts that in the entity, how the entity is able to generate those cash, means from where the cash comes. So if we see, either I can borrow the funds, I can generate through my activities running my operations, and because of that I will earn profits, and that profit gets realized into cash, so that way I can get those funds. These are the major two areas from where I can generate the cash. So that is my inflow area, and important is where I put those funds. So either it goes in my repayment of my borrowings, it goes into my expansion of business, so it is in investment activities where I am using. So this is, or if I am not able to generate proper operating profits, so whether I am incurring some losses, so I am burning my cash into my business. So these all things we will be able to identify from looking at the statement of cash flows. So this is the purpose. Basically it will provide us with the valuable information, maybe based on your past performance. So it is historical, right? It is not future, but historically how the entity has performed over a period of time, where it is generating the cash and how it is utilizing, whether it is burning the cash in the operations and making losses, or it is putting the money into investment so that ultimately it can grow in the future. I think these are the things which we will know once we look at the cash flow statement. So this is the basic purpose about cash flow statement. Next. So objectives, as I said, highlighting cash from different activities, shows the quality of profits. Short-term planning helps to understand liquidity. So as I said, how I'm going to manage those requirements of funds. Efficient cash management. This is specifically, I said, we will be covering at the end, where I have taken few examples from various industries, whether they are efficiently managing the cash or not. That is another important. Prediction of sickness. Yes, of course, as I said, if I am burning holes, I am actually burning my cash into operations, then I will know that future is not good, because I am not able to make money out of the operations. Actually, I am making losses. So that how that predictability is possible based on the quality of cash flows which entity is able to generate. And comparison is budget, always it is there, that how much I have planned, how much I have invested, whether it is as per the plan is going on or not. Those things I can compare always. So these are the objectives of state flow assessments. Next. Now, having understood the why cash flow, what is my cash, what is the cash equivalent, now let us go to classification of cash flow activities. So standard says that you have to basically classify into three parts. One is operating, one is investing, and one is financing. But actually, if you see real life map, everything starts from financing activity, because first you get the funds, either you bring it as a share capital or borrow the funds. Then the next thing comes is you invest into your machinery, plant, office, everything, and then you start your business. So that comes the operating. But here actually, if you see the flow of the statement, it is operating, investing, and the last thing the financing. And then we will be able to reconcile between opening and closing of the cash flow, cash and cash equivalent. So whether how much I have generated from which activity, that is what the purpose of cash flow will be. So now let us have a quick look at each items. Cash flow, operating activities. As everybody knows, operating is the main business activity. It is the principal revenue producing activity of the entity, and other activities that are not investing or financing activities. So if you remove investing and financing related activities, whatever left out will be your operating activity. This is how you have to define for the purpose of statement of cash flows. So whatever I'm using my cash flows, I'm able to generate out of my operating activity, which is the main revenue producing activity, that will come under my operating activities. Next. Now, as per the standard for operating activities, they say standard requires that it gives an option that either you can prepare your cash flow from operating activities by using direct method, or it can be by indirect method. Generally, if you see any of balance sheet, out of 100, 99 cases will be they are using indirect method. because it is very easier. In direct method, you need so much more information, because it is the actual cash flow which is flowing into the entity. And normally, you know, we prepare the financials based on accrual bills of accounting. So there everything is mixed. Cash is also involved and non-cash items are also involved. So it becomes very difficult to get those information unless you have a separate MIS kind of system which captures all these things. So that's why it is always easier to prepare based on indirect method. So 99% of cases you will find that people are using or entities are using for the preparation of cash flow from operating activity indirect method. Now if you look at my suppose what the AS3 says, what Ind AS-1 says, AS3 gives you both methods are okay. Ind AS-1 says that entities are encouraged to follow direct method. That is what the standard is saying, but it is not saying that only direct method is used. Now let us have a look at what other regulators are saying. Suppose we take SEBI for example. Then SEBI is saying that indirect method should be used for preparing cash flow from operating activity. Now, if you look at IRDAI, that is IRDAI regulations, there IRDAI is saying for general and life insurance companies, direct method is mandatory to be used. So if you are into a life general or life insurance company and there IRDAI is making it mandatory that you have to use direct method. So indirect method is not permitted there. So this everybody has to keep in mind. Okay, so this was regarding that. Now investing, next item is investing activity. As the words itself says, investing is that now for running my business I need to invest my funds into my long-term assets, or if I have some surplus fund I can acquire new companies where I can diversify business. So I invest in my subsidiaries or my joint ventures, my associates. All those activities comes under my investment activity. So examples are purchase of machinery, investment in subsidiary, those everything comes under investing activity. It is very simple. So any resources outflow inflow from this also will be covered under that. We will be seeing when we do the classification examples, what kind of activity fall under which kind of activity, right? So if I dispose of my machinery, then again it should be like investing, inflow from investing activity. I mean dispose of my subsidiary investment, then whatever proceeds I get, that will be again part of my investing activity. So this we will be seeing. And next one, it is financing activity. So again, as the words are saying, financing activities are activities that results in changes in the size and composition of the contributed activity and borrowing. So whatever kind of share capital, capital structure, my borrowings, debt, whatever is there which company borrows or gets the funds by way of issue of shares, those kind of activities will come under financing activities. So loan taken from bank, dividends paid. So when investors invest in my company, they actually want two things. One is that I should be able to give them returns by way of dividends or appreciation by way of increase in the share price. So dividend paid is relating to that return to the investors. So that comes under financing activities. Share capital raised, buyback of shares which I am doing, that again I am returning the capital. So that again comes under my financing activity. If I repay the loans to the banks from which I have borrowed, again it comes under financing activities. So these are the things we have to keep in mind. Next. Now let us try to understand in this case what should be the answer. An entity has purchased plant and machinery on a credit basis. The credit period has been lapsed and the payment has not been made. The creditor thus charges interest on late payment. Where will the impact of interest go in cash flow? And second question is, when that creditor is paid with the dues, where that amount will also be classified under cash flow statement. So first will be I am paying the interest, right? So interest should be your financing activity. But again the purchase of machinery, I am paying to the creditor that amount for purchase. So that actually I am investing, right? So that comes under, that principal payment will come under investing activity and interest will come under financing activity. Next. Another example, the parent company makes investments in subsidiaries. Subsequently, the holding company, means that parent, sells some proportion of stake without loss of control. So here most important word is loss, without losing the control. Under which activity of cash flow will this sale in stake be classified into? So here most important point is I am not disposing of that subsidiary. I am just managing my cash requirements. Okay, so without losing the control over the subsidiary, suppose I am holding 75% shares in that subsidiary. Now for short term, there is some liquidity problem in my company, so I wanted to manage that liquidity. So what I will do is, without losing the control, I may say, okay, I am disposing of 5% of my holding in that subsidiary. So instead of 75, now it becomes 70, but still I am the majority shareholder and I am actually controlling that subsidiary. So I am not losing any control, but by just selling of that, disposing of 5%, I am able to manage my cash flows, liquidity requirements. So the standard is very clear. In such kind of situation where I am not losing the control over subsidiary, it will be treated not as a investment activity, it will be treated as a financing activity, because I am selling that to manage my finances for that short-term requirement. So that's why it will be treated as a financing activity and not as an investing activity, right? Next, let us take few more examples of classification. Cash payments to manufacturer. Here important is for properties built to let out or give on rental basis. So my business is to get the properties done and let it out or give on rental. So rental business is my main business activity. So here it will be included as an operating activity, not as a investment activity. Next, purchase license of manufacturing a special product. So again it will be treated as a, because I am investing into that purchase of license, so that using that license I will be able to manufacture special products. So it is my investing activity. Next, royalty received on goods patented by the company. Again here I am actually receiving the royalty based on the patent. So some party is using my patent and based on that I am able to get the royalty. So again I have invested into that patent. So that's why it comes from cash flow from investing activity. Next, interest paid on loans taken by an entity. Very simple. Now here, if entity is a financing company, right, then it will be treated as a operating activity, because lending is the main business of that company. But other than financing, it will be and comes under financing activity. Issued employee stock option to employees. So here, as you see, at the time of issue of stock option, there is no movement of cash flow. So not to be considered as a part of cash flow, since there is no inflow or outflow of actual cash here. So it won't be captured. Next, provident fund paid for employees. It is, as you said, it is part of my payment to the employees. So it is a cash flow from operating activity. Next, interest received on loan and advance is given. So as you can see, generally when I lend as a finance company, then it is part of my operating activity. But if I am not a finance company and I am actually doing that lending, suppose, then it's a investment activity, whatever interest I receive out of that advances or loans. Next, interest and dividend received on investment in subsidiary, associate and other entities. As it is out of my investment, I'm going to earn that interest and dividend, so it has to be cash flow from investing activities. Third, dividend paid on preferences. So all kinds of dividend which I'm paying, right, it will be cash flow from financing activities, because as I said, I am giving actually returns to the investors who are investing in my company, so it has to be my financing activities. Now, finance charges paid by lessee under lease liability. Yesterday you have session on 116, right? Lease payment. So here you must have understood now that finance charges or repayment of that lease liability. If it was like operating, then previously it was going to as a part of your rent. So it was an operating activity. But now, and after that ROU asset came into existence, even for operating kind of activity, operating kind of lease, your lease payments and the interest on lease payments now will have to be considered as a part of financing activities, right? So this is very, very important change after 116 came into existence. Prior to that, for all operating activities or all operating leases, it was taken as part of your operating activity and not as a financing activity. Payment towards reduction, as I said, again it will be financing activity. Next, interest paid to vendor for acquiring fixed assets under deferred payment basis. So we are paying interest to the vendor, so it is a financing activity. Next, principal sum payment. So now again the same vendor, you are paying deferred payment basis for acquisition of fixed asset. So actually I am paying for acquisition of the asset and not for against borrowing. So here to the vendor I am making the principal payment, right? So ultimately why I have paid to that vendor? Because I bought machinery from him. That's why that is my investment activity. Now, however, if it is a penal interest, so see, you know that liquidated damages generally comes. That is part of my operating business, right? Why I am paying in penal interest? Because I could not fulfill certain timely payments also. So it is not like lending kind of activity. It is part of my day-to-day activity that we call it as a operating activity. So that's why it comes under cash inflow from operating. Best example is that LD kind of thing. Penal interest paid, same thing, it is operating. Interest paid on delayed tax payments, operating. And last one, interest received on tax refunds, because my tax related all payments and receipts goes under my operating. So this also will be under my operating activities. Next, so now the next is on foreign exchange transactions, because there can be next our topic is on Ind AS-1, which will be exactly covering foreign exchange transactions, right? So entity incurs so many items into foreign currency. So there will be always a translation from foreign currency to my reporting currency, or right. So there will be always a exchange difference involved. However, there are so many items in my balance sheet which are actually not realized as on the reporting date. So there will be unrealized gain or losses on those assets and liabilities. So if you go by AS-11 or Ind AS-21, wherever there is a restatement of assets and liabilities on the reporting date, you will have to restate those items if they are monetary items. Then there will be a unrealized gain or loss. But so there is no movement of actual cash because they are not realized. So under when you prepare your cash flow statement, you have to add it back, right? The effect of the same is shown in the financial statement in P&L. But however, when you prepare your cash flow, we add back those things because these are all unrealized gain or losses, right? So since there is no actual inflow or outflow, the same is to be ignored in the cash flow statement. However, forget about assets and liabilities. There are cash and cash equivalents which is lying in my books, which are actually in foreign currency, right? We can have EFC account, we can have subsidiary account when we consolidate. So these are all in foreign currency. That also gets converted as per restated as per the closing rate, right? So on those cash and cash equivalents which we restate by using the closing rate, there will be unrealized gain or loss. So here the standard says those kind of unrealized gain or losses which are because of the cash or cash equivalent which is lying in your balance sheet as on the reporting date, that you can't show it under operating or investing or financing activity. Those you have to state as a item of reconciliation at the end of the cash and cash equivalent between the two balances. so that it matches with your financial statement, whatever cash and cash equivalent showing. So that kind of unrealized gain or loss on cash and cash equivalent is to be shown as a separate line item after that cash and cash equivalent part, so that it matches with your financial statement. You cannot mix it with any of the operating or financing or investing activity which you are showing on the above, but it will be part of your cash and cash equivalent. This is how it will have to be reflected. That's why it is important. Now lease operations. Again, now you must have seen, because of 116, now there are, as far as the lessee is concerned, now there is much thinner line between finance lease and operating lease, because now everything will be treated as a finance lease. So your answer also accordingly will remain same in both the kind of things. But previously it was different before 116 came, or even now under 116, if it was for short-term kind of lease or low value item lease, so still it will be treated as a operating lease, right? It will not be treated as a your long term or ROU kind of. So there you are not doing any ROU kind of thing. It will be treated as a short term. So it will continue showing it as a rent payments. In that case, it will still remain as a cash flow from operating activity for short term kind of lease. However, for other kind of lease, where you create ROU asset and you create a simultaneous lease liability in your books, then all payments, whether it is towards principal payment or it is towards your interest charges, it will be treated as a cash flow from financing activity. And same way, if it is purely for finance lease actually, then again interest portion will and the principal payment both will be shown as a financing activity. So now the answer remains same, except that wherever you are using that short-term exemptions, then in that case rent will be treated as your operating kind of activity and not treated as a financing activity. I think this is the major change you will have to keep in mind based on 116. Okay, next. So now cash flow utility from investors point of view. I think this is what I explained in the beginning. Cash flow is very useful for any analysis of an entity and type of transactions it undertakes. This is because the cash flow statements give a clear picture of how the funds were raised and where the funds are used. It throws light on the capability of management to manage the cash resources efficiently and productively, because this is very, very important. This is where it will throw light. And the strategy of management related to dividend policy and buyback of shares if it is not able to utilize productively in the business. And generally you will find, if you look at the cash flows, you will be able to find out what is that cash management policy with the management applies. So we will be seeing into that 3 examples which will come in the next few slides. Next. Yeah. Now presentation transaction in cash flow. So if generally the rule is that you can't mix repayment and borrowings, because these are two different. You can't mix purchase of fixed assets and sell proceeds of fixed assets. Both are different, right? So, but however, there are certain exceptions where you can actually show it as a net. So when you can show it as a net, when those funds are not yours, so you are acting as an agent, suppose. That is the very simple example. So in that case, the funds are not yours, it is the funds of your principal. So there you can show it as a net basis. Otherwise, you cannot net it off. This is one of the, even in case of banks, wherever there is short-term deposits coming, going out, lending and all those things. So there for them it's a product. So in that case, they can show it as on the net basis. Otherwise, for other than financial companies, wherever such kind of repayment or borrowing of loans are there, they will have to be showing separately disclosed in the cash flow statement. It cannot be netted. That is very important. Now, as I said, let us have a look at. I have picked up 3 kind of industry. One is manufacturing industry. Then I have taken one example of service industry, and the third I have taken example from the startup kind of activity, which is in e-commerce kind of thing. So these are the real life. I have taken 2019 balance sheet. So if you see C8 tire, suppose. So actually Next page. Yeah. See, net cash flow generated from operating activity. You will find that 53,275 is the what they have generated out of business, right? Now take the next one, cash flow from investing activity. Now here if you see investing activity, total they have utilized is 105,206, right? So now third component is your cash flow from financing activity. Next, so here if you see they have borrowed funds to the extent of 50,395. So it means any analyst who wants to look at this cash flow, he will be able to understand that the management actually wants to grow the business. They are able to utilize whatever funds they are generating out of operating activities. Still they need to borrow so that they can put it into your plant and machineries. If you see that major component goes into purchase of the PPE, right? So that means there, see 106,215, this is what they have invested into expansion, purchase of PPE or correct. So it means management is very clear, they want to grow the business, there is a scope for growing the business, and they are very sure that it is safe to keep the funds with them, because the returns which they are able to generate out of utilizing those funds will be much more than if I give that funds back to the shareholders. And that's why shareholders also will be happy, and such type of company always you will find that market prices will be much better and the company will have a very, very long-term positive outlook as far as the analysts are concerned. This is how information we can get from just looking at the cash flow statement, right? So take the another example, there will be some contrast. So now next example is of Infosys. There is a service industry, right? So here again if you see they are able to generate some 14,000 of worth of cash from the operating activities, right? Now where they are investing? Next. Yeah, they are not investing. See, only 575, right? So then what they are doing with that funds? In this case, if you look, they are actually giving back those funds to the shareholders. So they have actually net cash used in financing activities 14,512. It is almost like how much they have earned during the year from the operating activities. Actually, they are giving it back to the shareholders, right? So they have earned actually 14,000 something, and that much same amount they are giving it back to the in the hands of the shareholders. What does it mean? And they are actually keeping almost on the same level the cash flows. Last year it was 19,871. This year it is 19,568. What does it mean? Here the management feels that because it's a service industry, manpower is the main asset. They don't need to invest into brick and mortar kind of things. Major assets are there, maybe on rentals, computers, all those things, and manpower is the main asset. So here, unless they acquire certain new businesses, subsidiaries, they will not need those funds. So they say instead of keeping here, or what they will have to do is they will have to invest into like units of mutual fund, FDs. So there, I don't think they will get better returns. So in this case, management has followed the policy that it is better if I give those funds back to the investor, so that they can, if at all they need, they can invest somewhere where they can have better returns than investing here. So this is another kind of strategy which such kind of company can adopt, and Infosys is doing the same thing, right? So in CAT, we have seen that it is invested into PPE. It means there is a growth they are looking at. There are expansion possibilities are there. So that's why management is sure that it is better to keep it in the business. In Infosys kind of example, management feels that it is better I give it back to the investor, let them do whatever they want with their funds instead of keeping in FDs, because they don't want to, they don't require this fund because they are consistently generating out of that operating activities, and they are not able to invest it properly, right? So this is another example. Now take the third example, that is startup kind of. So this is an example of Swiggy actually, and it is not a listed entity, so you can't find those some proper. So that's why here, if you see the cash flow, here they are burning cash. Cash from operating activities actually 1.9 billion. It's a whole losses, 1.9 billion losses they have incurred. And from where it came? From new round of investments, from financing activities. So all time next round from the investors. So that's why they have brought in those funds, but just to run their operating activities. And why there are losses? Because of discounts and huge marketing and discounts they do, right? That's why they are burning that case. And if you see how much they have invested into PP, hardly anything. 98, nothing compared to 1.96 billion. So that's why here you will see the such type of industry, which is actually startup kind, e-commerce kind. Here they are more interested into how many customers they are able to repeat, how many customers they are able to generate, and for that they don't mind spending in discounts, marketing, whatever they need, because they are confident that market share is very important for them. Once that market share is captured, then actually either they will be able to charge the customers very good price so that they can start earning the revenue. I think best example is BookMyShow. If you see BookMyShow in the initial period for maybe 2-3 years, actually they were not charging anything for providing the services. So we all used to getting that services. We thought that okay, by sitting at my home before standing in the queue, if I am able to get whatever seat I want of my choice, then why go and stand in the queue? And that there should be, I don't want any uncertainty if I reach there and I find out that I'm not getting the proper ticket what I want. So that's why they started actually making us habitual, so that again and again we use their platform to book the tickets. So once we were habitual for 2-3 years, so we became addicted, right? So then they started charging us for each ticket. When I book, now they are charging me 30 rupees or whatever, I don't know. So now they are doing fantastic profits. And so now what I will think, because last 2-3 years I am so much addicted to this type of using of service, that now I don't mind paying them, because I think okay, यहाँ से बैठ के मैं एक click of the button, if I am going to get those tickets which I want, then why to there should be any uncertainty and go there and stand in the queue, right? So such kind of companies will succeed now, because now they will start generating profits. But initially for few years, because they wanted to give this experience to the customer, they wanted that the customer should actually get habituated with the new habit, so that it becomes addiction. Till that time, let us burn the cash, don't charge anything, provide free services. However, they were incurring losses, right? So they were burning cash, but this was their strategy, and they succeeded. BookMyShow is the best example of that strategy. They have succeeded now, so they are now charging the fees, and they will turn into profitable company and growth company, and that is what I think is happening. So in Swiggy also they are trying this, but as you know, startups, out of 100, only maybe 1 or 2 will succeed, 98 will die down. So there that money will be gone, and this is what even the venture capitalists or private equity funds know, that if I invest in 10 such startups, success ratio will be only maybe 10%. So out of that 10, only 1 or 2 will succeed. But whatever success ratio will be there, the quantum of profits which they are, or the returns they are going to get, that will actually take care of other 8 losses which they are going to incur. So that's why you will find only private equity or venture capitalists entering into this type of e-commerce companies. Public will not enter. Public will enter at the later stage when they get it listed, right? Or it will happen the case that what it happened into Flipkart. Walmart bought it, right? So this is how either it will be bought out by some big company. There also investors will be able to get their returns, or it will get listed. Like in the case of, I think, Book My Show, this is going to happen. They are now making profits. So this is a success story. However, we don't know what will happen to, I think Zomato also is sold out, right? So these things happens in e-commerce industry. But here again, from the cash flow, you will be able to understand what is the where the money is coming from and where they are using those monies. So that's why I thought, let me take three kinds of industry, different kind. One is from manufacturing, one is from service, and one is from e-commerce, so that you will be able to understand how important it is to look at cash flow statement, to understand what the management is thinking, whether they are in expansion mode, or whether they are saying that no, I am okay with whatever investments I have made. I will give those funds back to you in the case of Infosys. Or in Swiggy kind of industry, we have seen that they are heavily burning the cash, so that people get habituated at one day, maybe after 2 years, 3 years, so that when they start charging fees for that services, we say, okay, no, we don't mind, we will pay, and then that turnaround will happen and they become profitable. I think these are the strategies of three different kind of companies we have seen, and this is how actually in real life it works. So hope friends, I was able to clear as far as the cash flow is concerned, and few more points I can say as far as the cash flow statement is concerned. Yeah, what kind of activities will not be considered as a cash flow? Cash flow will not include like conversion of term loan or debt into equity, redemption of preferences by conversion into equity. So actually I am not paying you, I am just converting into equity. So from one it gets converted into another, there is no movement of cash actually. Nothing comes in, nothing goes out, right? It is from one item of the balance sheet to other item of it. It just changes the name. Otherwise nothing, no movement of cash. So this will not be part of your cash flow statement, correct? And if there is a movement between cash and cash equivalent, that also will not be captured under cash flow, because it is the part of cash management. So if suppose short-term deposit I have kept and that gets matured and it is converted into bank balance, so this will not be captured under your investment, because it is part of my cash management. It is a part of cash and cash equivalent, right? So those things will be not covered. Now DDT, dividend distribution tax, which is part of your dividend payment, so it will also go with the dividend, so it will be part of your financing activity, right? Now standard says that out of the cash and cash equivalent which is lying with you, how many items are actually restricted or not available as a part of cash and cash equivalents. Those can be actually unpaid dividend account which is there in the bank, so those bank balance you can't touch under law. Share application money which you have received and it is lying in a bank balance, that bank is actually cash and cash equivalent, right? But you can't touch that share application money, because it has to be either allotted the shares or it has to be refunded back. Bank account for debenture redemption, share buyback, dividend payment, for that under law you are required to open a separate bank account, right, and transfer those funds which are to be paid as a dividend redemptions or share buyback or dividend payment. So again, even if the funds are lying in your bank, it is part of your cash and cash equivalent, you can't touch that fund. So that's why these are restricted funds. So you will have to, as a part of that note, you will have to put that out of that above cash and cash equivalent, this so and so funds with the nature explained, which are actually not available for use. So that restriction on use has to be given as a part of note in your finance statement under cash flow statement, so that whoever is the user will be able to identify that which are the funds, even though it is lying in the cash and cash equivalent, will not be available for use by the management. It are not fee funds. Okay. And last thing, reconciliation will be required between cash and cash equivalent and what is shown in your financial statement and what is shown in your statement of cash flow. That reconciliation can be because of two things. One is that bank OD, in your financial statement you may show it as a part of borrowing, but for the purpose of cash flow statement of cash flow, it is included as a part of operating, right? And foreign currency cash and cash equivalent, there again we have said that separate line item is required for unrealized gain or losses, that has to be shown separately as a line item. So these are two items which you will find generally in the statement of cash flow and your cash and cash equivalent, which is depicted in your financial statement. So this you have to take care. I think that's all from me as far as cash flow statement is concerned. And Mr. Virag, hello. Are you there, Virag? So we want to break, or we continue with next standard. So Nikit, you can go for that Ind AS-1 now. So friends, let us start with another very important standard, that is Ind AS-1. Before we go to how Ind AS-1 works, let us understand under IGAP we have a standard name AS-11, that is same standard and with the same name, that is the effects of changes in foreign exchange rates, right? So first let us understand, mostly the translation procedures are almost identical, so that way it is not something very different, but fundamental differences are there that we will see once we go to the next steps. But let us understand how we are dealing with foreign exchange rates under present scenario, under AS regime, right? We call it as IAS regime, IGAP regime. So let us see accounting for transaction in foreign currencies, how we deal with the income statement impact, how we do with balance sheet impact, and what we do for long-term foreign currency monetary item under AS GAAP. Now, as you know, there can be foreign currency transactions either when I buy something or import something from outside the country in a currency which is different from my currency. That is normally under AS-11, any Indian company who is having a domicile in India will always use measurement currency as INR currency, right? So our measurement currency, also known as reporting currency, is INR. So under AS-11, any other currency other than INR will be treated as foreign currency. So under AS or IGAP regime, we have only two types of currency. One is measurement or reporting currency, that is we call it as INR for Indian company. Any other currency other than INR will become a foreign currency. So now let us see how we deal with those things. So as I said, I am an Indian company, so my reporting and measurement currency is INR. I am purchasing some fixed assets. I can purchase raw materials from maybe say China, US, and I am actually, they are charging me in US dollars. So that US dollar is my foreign currency. So as per AS-11, whenever there is a transaction in a foreign currency, at the initial recognition time, I will record it at the spot exchange rate, which is applicable on the date of the transaction. And I will record that transaction in my books. Maybe it is a purchase, maybe it is a PP, whatever. That's how I will account it into my INR currency. Now, whenever I make a payment for that purchase, again, when there is a payment in that foreign currency, that on that day, what is the spot exchange rate, I will convert that and record it in my books. So now what will happen? Initial recognition, say suppose my rate was 65 per dollar. When I am making the payment, maybe after 2 months, at that time it is 67. So the difference of $2, actually, that 2 rupees, that actually is a foreign exchange rate difference. That, as per AS-11, if it is within the same year reporting period, it will go to my P&L account as a exchange difference gain or loss, right? And that transaction get settled. Now suppose in between a reporting period comes, that is 31st March, and I have not yet paid to that vendor, or I have not realized against that export which I made, right? So how I do? So because the standard said if it is a monetary or non-monetary, that is how you have to classify. If it's a monetary item like receivables, payables, right? So that I will have to restate using the closing rate as on the reporting date. So again, there will be a exchange difference between the initial recognition date and the rate which is applicable on the closing rate. So suppose, as I said, in initial recognition, I had booked at 65, and now as on 31st March, the rate is suppose 70. So that 5 rupees ka difference, again, I will have to book, and it will go to my P&L account. This is how we are dealing under AS-11 for income statement impact. And balance sheet, as I said, we see that whatever is my item, whether it is monetary or non-monetary. If it is non-monetary, I will do nothing, or initial recognition ka jo bhi rate tha, that is freezed. If it is a monetary item like receivables, payables, that becomes my monetary. So I will have to convert them, restate them at a closing rate. So that's why that amount will change in the balance sheet. So receivable का amount change हो जाएगा, payable का amount change हो जाएगा, and difference जो भी था हो जाएगा अपना P&L में as a exchange difference, gain or loss. So this is how I deal in my balance sheet as per AS-11. Now coming to the third item, that is long-term foreign currency monetary item. Here in this case, how they define long-term foreign currency monetary? Suppose I have borrowed something in foreign currency and it is a long term, so more than 12 months from the original date. It is repayable after 12 months, not within 12 months, so it becomes my long-term foreign currency. So if you remember in 2009, then 2011, we had that huge crisis, economic crisis around the globe. So because of that, there was huge volatility in exchange differences. So how actually in the present situation in COVID scenario also we may face that recessions are happening, volatility is there every day, up and down are happening. So in such scenario, that there were that crisis in the US in 2008, and because of that there was a huge volatility in the exchange rates. So industry went to the government and they requested that there should be allowed some window so that on such kind of foreign currency monitor, like उस वक्त क्या था, ECB loans were there, FCCB was there, huge. So if because of that fluctuation, if they had to book it in P&L, that restatement difference, then in single year there would be a huge amount of losses because of this exchange difference. So government permitted them by way of para 46 and 46A in AS-11, they amended and they said, okay, it's a choice which we give to the entity. If they want to go for this choice, then any exchange difference on that long-term foreign currency monetary item, instead of taking it to P&L account, they are permitted to park it in. If it is for the purchase of depreciable asset, then that exchange difference will go to capital asset, means that PPE or whatever, which is a depreciable, and you add to that cost or deduct from that cost and amortize over a period of the life of the asset. If that borrowing was done and used for, suppose, working capital requirement of the company, then here we are not, it is not for a depreciable asset. Then they said under 46A, such kind of exchange differences on such monetary long-term foreign currency monetary item, you can park it under FCMITDA, foreign currency monetary item translation difference account, and it will be directly taken to your balance sheet instead of taking to P&L, and it can be amortized over a period of that loan. So this option was available, which was irrevocable. So once you use that option, there was no possibility that you can go back from there. So you have to, once taken, you have to go by that option only. So this is what there. Then they extended again and again from time to time. Now that sunset clause already has happened on 31/3/2020. So henceforth 46A is irrelevant. So from now onwards, from 1/4/2020, any loan which is a kind of long-term foreign currency monetary item, you are not allowed to park it either in the balance sheet in part of, as a part of foreign currency monetary item translation difference account and take it to balance sheet, or park it as a part of cost of depreciable asset. This option is now no more available on all kinds of long-term foreign currency monetary item. Wherever there is exchange difference loss or gain, it will hit your P&L account, unless government comes out with some again modifications or extension. Already this period is gone, so now there won't be any relevance for as far as this item is concerned. All kinds of long-term monetary item, exchange difference gain or loss will go to your P&L henceforth. Okay, but it was applicable up to 31/3/2020. Now under AS-11, translating the foreign financial statement of a foreign national. So suppose I have a subsidiary in US, and now every year, because I am a parent, I have to consolidate that financial statement. For preparing my consolidated statement, I need to translate those operations into part of my balance sheet for consolidation purpose. So under AS-11, they said first you identify whether that foreign operation is your integral or non-integral. If it is integral, then it means there is no difference. So whatever exchange difference you get because of the translation will go to your P&L, right? And if it is a non-integral, I think they said that if it is not dependent on you, and they are independently automated structure is there, they are able to take decisions, they are not dependent on the parent for any funding or something, then they say okay, I'm interested only for appreciation or dividends, I am not interested in your cash flows. So in those cases, whatever exchange difference was there on consolidation, that was taken to FCTR account in the balance sheet and not to P&L account. This was the main difference when translating the financial statement of foreign operation with the parent for the purpose of consolidation. These are the two approaches. In one, when it is integral, everything exchange difference went to my P&L account. If it is a non-integral foreign operation, I took it to FCTR account. There is a third kind of item which is there, monetary item, which in substance is a net investment in foreign operation. What does it mean? So my net investment actually is either in my equity subsidiary which I have made the investment, suppose that is my actually net investment, right? Or they are saying, suppose I have given a loan which is say for 10 years or 20 years, and I have an agreement with that subsidiary that after the end of 20 years, either I will extend that period of loan, or I will once you repay me, immediately I will give you back the loan for another 20 years. So effectively, in such kind of situation, it means that I have invested that loan with the intention of never getting it back. So it is akin to investment in my equity. Those kind of long-term loans, right, receivables, which is akin to equity, standard says that those are the items which we call it as a monetary item, which in substance is a net investment in foreign operation. So when I do the translation procedure, standard says that such kind of जो monetary item है, जो actually मेरा equity जैसा है, उसका जो exchange difference आएगा when I translate into my parent company for the purpose of consolidation, I will not take it to my P&L. It will go to my FCTR. Okay, and even when I am actually doing that separate financial statement also, parent is preparing its separate financial statement as on 31st March suppose, and there is a line item lying as a monetary item as a loan given to subsidiary. So that also, because it's a monetary item, normally I will have to restate. So that difference also will go to my FCTR and not P&L. This is the main difference. Okay, so this is how you have to keep in mind. Now, once we have seen under AS-11 how we are treating all those items, my income tax, income statement impact, my balance sheet impact, how I deal with that 46 and 46 paragraph, that also we have seen. How I translate my foreign operation for the purpose of consolidation, there we have seen integral, non-integral, then monetary item akin to my equity, how the standard says we deal. So these are all important as far as AS-11 is concerned. Now the last item, restatement of financial statements from reporting currency to another currency. So now most important point is, as I said, under AS-11, if I am a Indian entity, then generally I will go by my INR as my measurement as well as reporting currency. Also because of Companies Act Schedule 3 requirement, I will have to prepare my financials in INR, or even for my other statutory filings purpose for GST or any other income tax, INR is my reporting currency. So do I have an option under in IGAP if I want to present in some another currency? Suppose I want to present in US dollar. Do the standard gives me that kind of guidance? Unfortunately, no. So standard is not providing any kind of guidance. So indirectly we can say under AS-11 or IGAP regime, we don't have such kind of permission to present in some another currency. Or if at all you do, then it will be not in line with AS-11, because AS-11 does not give any guidance. However, when we will go to Ind AS-21, you will realize there it's a detailed specific guidance is available to present my financials in other than my reporting or functional currency they call. So their permission is allowed, and second thing, they have also provided how it should be done. Such thing is not there under AS-11. This you should keep in mind. So this is what was how we are doing it at present under AS-11. Now it's time we move to Ind AS-21. Next slide. Facts. If you compare now IFRS first they introduced IAS-21, that is corresponding to our Ind AS-21, way back in 1983. It was thoroughly revised in 1993 and completely changed in 2003. If you come to our Indian GAAP, our history is not that old. AS-11 first was introduced in 1989. Then it was once only it was revised, and that was now kept in line with what IFRS has done in 2003. So that's why I said almost things are similar. Only main function difference is that fundamental differences of functional currency that we are going to take up in the next slide. Next. Yeah. So as I said, under Ind AS-21, one major fundamental difference is difference of functional currency. Now under IGAP we have seen we have two kinds of currency, right? One is your measurement or reporting currency, that we call it as INR. Any other currency will be called as foreign currency. Under Ind AS-21, we have a third currency. That concept is known as functional currency. So if you see now under Ind AS, we will have three currencies. One is functional currency. Rest of other currencies will be known as foreign currency, and third will be the presentation currency. So here now that option is available, that even though you identified that suppose INR is my functional currency, then in which currency you want to present your financial statements. Either it can be in your functional currency, or you have a choice that if I want to present in US dollar currency, then standard permits you. So that we call it as a presentation currency. And as you know, other than functional currency, all currency will be your foreign currency. Now that's why it is very important, because under IGAP it was very simple. Now your INR is your main currency, that is your measurement currency. तो बाकी कुछ आपको सोचना ही नहीं था. यहाँ पे under Ind AS, most important thing is first you need to identify what is your functional currency, and that is not that easy. So entity to entity, each entity will have to first do this exercise to identify what is my functional currency. So now standard gives a detailed guidance how to do that. So that is what is there in my slide. So if you see, standard says that functional currency is that currency which is the primary economic environment, which influences by the primary economic environment, or where the entity operates and which gets influenced by that environment. That environment जो भी है जिसका currency influences that entity will be the functional currency. It gives guidance how to do. So there they are saying I have primary indicator, I have secondary indicator. First you will have to utilize primary indicator, use it. If you are getting the clear answer that by using that primary indicators you are identifying a particular currency as your functional currency, then you have not to go further for the secondary indicators. You have identified your answer, that becomes your functional currency. If there is a tie in the primary indicators, then standard says you can go to the secondary indicators to find out whether it helps you to identify clear cut what is your functional currency. And then based on primary and secondary indicators, you have to identify a particular currency which fulfills those criteria will become your functional currency. However, there also sometimes there is some doubt, then standard will allow you that it's a management judgment, and based on what management feels, not only feels, they will have to list out based on what criteria they have applied, and those criteria they will have to disclose as a part of notes, based on which they found that even though my primary indicators was not very clear, secondary indicator also were not able to give me the clear answer, but based on what management has applied their judgment, they have concluded that so and so currency is the functional currency for the entity. Those judgment they will have to disclose as a part of notes to accounts. This is what the standard requires. Now let us see what are my primary indicators. So here in this slide, if you see, there are 5 items mentioned. So what that upper part, you will see there are 3 items are involved, and lower part there are 2. So that lower part is actually secondary indicators, upper part is primary indicators. Now how to read this? See, in primary indicators, that first 2 items, currency that influences sales price and currency of the country whose economy determines sales price of goods and services, these 2 you have to read as a one item, and then you have to compare that with that other part, that is currency that influences labor, material, other cost. So one part, if you see, that is my revenue side, sales side. Other part of primary indicator, if you see, that gives you cost, operating expenses. So if your answer is that both the parts give you the same answer, like suppose conclusion is that INR is the currency, then based on the both the indicators, primary indicators, you are able to conclude that yes, currency that influences my sales price is INR. I am operating from India, and that is the economy which is actually determining my sales price. So taking these two, your answer is INR, suppose. And because you are in India, your plant is in India, your everything, all expenditure relating to purchase, sale, purchase or labor cost or plant and machinery, everything is in INR. So based on these two criteria of primary indicator, here you are able to clear cut identify that INR is my functional currency. Then standard says not to go further to the secondary indicator because you are able to identify. However, suppose I am into 100% exports and I feel that okay, my first answer is coming into US dollar, like currency that influences and the currency of the country which influences my sales price. I am actually competing in US market. So based on that, suppose my answer comes to US dollar. And other indicator, that is primary indicator, is currency that influences labor. But however, because I am based in India, my manufacturing facilities in India, all my raw materials, my labor cost or my operating expenses, I am incurring in INR. So I am getting answer as INR as far as the second part of the primary indicator is concerned. So here there is a tie, right? First answer is giving me US dollar. Second part of that limb is giving me INR. So there is a tie here. So in that case, standard says you have to go to your secondary indicators. So where secondary indicators I will have to apply in only cases where there is a tie. What they are saying, currency in which the funds from finance activities are generated. So how I have borrowed the money, whether it is in INR or how I have raised by capital, that is in INR or not. So that also I will have to consider, and currency in which operating cash receipts are retained. So suppose I am selling in US market, so I am getting funds in US dollar, I can park it in EFC account also. But if I am converting everything, that realization into INR, then it means that I am parking everything in my, retaining everything, my receipts into INR. So now based on secondary part, if I conclude that majority answer is INR, then functional currency of that entity will be INR. So this is how you have to apply your primary and when to apply secondary and then how to conclude, right? So first and foremost important part is, if you are able to get the answer in the first part, primary indicators, not to go further, now you know what is your current functional currency. If there is a tie, then only you go to your secondary currency. This is how you have to apply this standard, because as I said, only determining functional currency is important. Once it is done, almost all things are similar to what you are doing under AS-11. So that's why I'm giving more importance to this slide, particular slide. Hope I'm able to clear your doubts, but we will take few examples so that you will get clarity how to apply those things. Now, as I said, if there is a mixed indicator, so even after applying first two, primary as well as secondary, you are not able to get the answer. Then I said management has used judgment. They determine the functional currency that most faithfully represents the economic effects of the underlying transactions, events, and conditions, and they will have to disclose that why they have arrived at this conclusion, what judgment they have applied, and that also they will have to disclose. This is very, very important. Next. Now, having identified your functional currency, is there a free choice to change? Okay, today, because this is favorable to me, so let INR be my functional currency. But next year there is a volatility, so let it change it to US dollar as a functional currency. No, sir. Because as we have seen, functional currency is what? It is fundamental to my business, right? So it is based on many factors which influences my sales price, my labor, my material. So unless those underlying conditions of the economy changes, you can't change your functional currency. It's not a free choice. Once it is determined, unless all those conditions drastically change, so that you have to re-evaluate your functional currency, till that time you cannot change your functional currency once it is properly identified. So it's not a free choice. So now let us take few case studies to identify, given based on the given facts, which is the currency. So in this case, my entity is in India. My 80% sales are in to the US country, that is USA. So I am realizing my funds in US dollars. So based on this, can you identify the functional currency? Answer is no. Why? Because information is insufficient. Because as we have seen, primary indicators has to be available. That is that three circles which is there in my first part, upper part. So that has to be fulfilled. Here they have given only denomination of my export bill, that is in US dollar. They have not given which country or currency of which country influences. They have not given any information about my expenditures, my operating cost which I am incurring in which currency. So here in this case, we are not able to identify the currency because of insufficient information. This is the answer for this case study. Hope you are able to understand how it is to be looked at. Next, in this case study, they have given that sales, that is also 50% is in INR, 50% in US dollar. Purchases also it is 50-50. So we feel that we don't have any other expenditure, only these are the expenditure for the purpose of our assumption here, for example. So in this case, if you see my revenue side as well as my expenditure side, it is a tie, right? So the standard says you in such scenario you have to go to your secondary factor, because first primary factors are providing a tie, you are not able to determine functional currency. So we have seen that under the secondary factors we have two things, right? One is how I'm borrowing my funds, financing activity, how I'm doing, and when I'm realizing the funds, in which currency I am retaining those funds, whether in US dollar only I am keeping that funds or I am converting into INR. So here they have given profit US dollar 30 converted to INR on receipt. Immediately it is converted into INR. So based on my primary indicators and the secondary indicators, we can say that for this limited case study, INR will be the functional currency, right? This is how we will have to apply primary and secondary indicators. Next. In this case, if you see the information which they are giving, they have said share capital, that is in INR. Primary currency they have given, it is INR. So share capital I have used issued in INR. Retained earnings are again in INR. Borrowings, they have said it is US dollar primary. So based on this information, are we able to identify the functional currency? Have they provided us any information relating to primary activities or primary indicators? Unfortunately, no. Only they have provided everything relating to my secondary indicator. However, based on a presumption, how we can read this? One is very clear, share capital, it is INR. Retained earnings, they are saying it is primary currency is INR. So it means my operations are based in India, my revenues are in INR, and hopefully my expenditure is also in INR, because primary currency, that third column which they are providing, they are saying that in which currency I am actually generating those funds, right? So we can say that extrapolation of retained earnings related information, we can say that okay, based on this, if I have to construct what will be my primary indicators, then I can say yes, because retained earnings, everything is in INR. So my operations also has to be in INR, and maybe my answer will be INR. So only because that borrowing is 200 in US dollar should not influence our decision. We have to apply, try to find out whether I can extrapolate out of this information to find out what could be my primary indicator. So based on that, if we conclude that my primary indicator is INR, and even the secondary indicator, because my share capital return earnings are in INR, so majority of part is INR. So my functional currency in this case is INR. This is how we can apply. Next, case study. Determine the functional currency in each of the following situation. X Limited, an Indian company, prepares its financial statement in INR. X Limited engaged in business of exporting automobiles to overseas countries like blah blah blah. X Limited sales price of automobiles are largely influenced by currency rate movements of the respective countries. For example, when exchange rate to INR changes, the sales price also changes. So based on the information, we can conclude that INR is my functional currency, right? Next. Another example they have given. X Limited is an insurance BPO service entity and provides services to many international clients. As a strategy to provide best business deliverables, most of the staff of X Limited are foreign expatriates, and their salaries are directly remitted in US dollar to their accounts in respective countries. So what do you feel? What should be my answer? What we have to think here, right? See, first is that what is the strategy of the company? See, I can be a insurance BPO company sitting in India and providing services off-site, sitting in India and providing services to the customers outside India. That is possible. Or as a strategy here, they are saying to provide best business deliverables. Majority of my staff are expatriates, so I am actually recruiting them in that particular country, foreign country, not Indian country, right? So suppose it is US, my customers are in US. So to provide them better services, I am actually recruiting majority of my staff in USA. So my benchmark labor rate will be USA, right? So that economy which will influence my sales price, the economy which will influence my labor cost, in this case will be US economy, and that is dollar. So based on this analysis, in this particular case, even though that company is suppose having their domicile in India, but functional currency will be US dollar. This is how you will have to apply. Next. Now, having understood how to identify functional currency, now next is very important, how we deal with foreign operations. Under AS-11, we have seen that we have integral and non-integral foreign operation. Under Ind AS, they have removed that classification based on integral or non-integral, but indirectly they are still saying that you have to apply those same factors. Only that wordings they have removed, that you can't say that it is integral and non-integral. It is based on the functional currency which you will have to identify for each foreign operation. And to identify that functional currency, they have given some additional factors. So now we have three kinds of factors. One is primary, one is secondary. And whenever there is a case of foreign operation, you will have additional factors only to look when there is a foreign operation. When you are to identify functional currency of foreign operation, you have to also use additional factors. So what are my foreign operations? Foreign operations is an entity that is a subsidiary, associate, joint venture or branch of a reporting entity, the activities of which are based or conducted in a country or currency other than those of the parent or reporting entity. So those will be my foreign operations. Now next. So as I said, wherever there is a case of foreign operation, standard is given additional factors that to be considered. If you read these additional factors now, you will find that ultimately it is drawing towards that integral or non-integral only. So what they are saying, degree of operational independence from parent. So if it is autonomous body, then you can say it is independent of the parent. Second is proportion of transaction with parent. Suppose I am only allowed to purchase from my parent. I don't have a right to purchase in local. I only to sell to the customers of my parent. Whoever they say you have to sell to so and so, then I am only selling to them. I am doing what? I am just collecting those funds from that customer and remitting those funds back to my parent. So proportion of transaction with the parent is actually maybe 100% of my total transaction. So that proportion has to be seen. Third, influence of cash flows on my parent's cash flows. So whether how much my parent is dependent on the cash flow from subsidiary. As we have seen in that case, if parent is actually exporting only to subsidiary and that subsidiary is actually selling to the customers of the parent in that country and remitting back all the funds to the parent, so my parent ka cash flow will be highly dependent on that subsidiary ka remittance. So if it is more and more parent is relying on the for the cash flows on the subsidiary, then we can say that it is a kind of integral kind of operation. Fourth, whether that cash flows of the subsidiary is sufficient to service debt obligation of that subsidiary. Suppose subsidiary has borrowed funds, whether it is able to service those funds on its own, or it depends on the parent to send the funds so that subsidiary can actually repay to the from where they have borrowed, or they can repay the interest. So if subsidiaries depend on parents' cash flow, then we can say they are dependent on each other. It is not independent. However, if subsidiary on its own cash flows is able to manage those, service those debts, lender when providing funds is directly looking at subsidiary and not to the parent for the guarantee, then we can say subsidiary is independent of the parent. So again, it is integral or non-integral. So indirectly, additional factors also leads to that you have to identify whether they are dependent or independent. If they are independent, then chances are that subsidiary ka functional currency and parent ka functional currency will be the same. However, if they are independent of each other. Like subsidiary अपने आप सब काम कर रही है. It is not depending on parent. और second thing, parent भी क्या है, investment किया है subsidiary में, but is not interested in day-to-day business with the subsidiary. उसको डिविडेंड मिलता है तो अच्छा लगता है, या फिर लॉन्ग टर्म में एप्रिसिएशन होगा, दैट इज फाइन फॉर द पेरेंट आल्सो. इन दैट केस they are independent of each other, then mostly we will have to identify functional currency based on the primary and secondary factors. This is how generally in practical life we identify functional currency of the foreign operation, right? So now let us quickly take few case studies. In this case, the parent is a company A, which is a Dutch, subsidiary is company B, London. They have given the facts about subsidiary. Company B trades in crude oil in US dollar, substantial sales and purchase in US dollar, other significant transactions in pound, share capital issued to company A denominated in euro. What is the functional currency? Prima facie, based on, if I say that my majority of transactions is in US dollar, so here answer will be US dollar. Next, there is a parent in England. Uska functional currency they have given, it is a pound. There is a subsidiary. They are saying we have to identify the functional currency of subsidiary. Its share capital of the subsidiary is in pound. Investments with the subsidiary is making, like in short-term deposits or maybe in equities or whatever, that is in dollars. Subsidiary does not have any other operation, right? So here actually subsidiary is the extension of parent. If you see, parent has actually routed the investment through subsidiary, maybe for the purpose of tax benefits, or maybe call it safe havens or tax havens. Maybe that can be the reason. So actually subsidiary is defunct company here. It does not have its own operation. Parent is using the subsidiary as a conduit to invest in branches. So in this case, subsidiary will not have its own functional currency, which is different from parent currency, because subsidiary will be treated as an extension of the parent itself. So my parent company ka jo functional currency hai will become the functional currency of the subsidiary also. So in this case, it will be pound. Next. Here in this case, we have to identify, actually we are running out of time, sorry for that. So we will be now, because main point will be that one more item is there, that is advances received and given. So that has to be properly understood by you. So in this case, actually subsidiary is not autonomous. If you read, subsidiary is dependent on the parent, because everything it is doing on behalf of the parent. So in this case, even though subsidiary is in US, it will be INR, because parent का ही वो extension हो जाएगा यहाँ पे. It is not automatic. So in this case, answer is INR. However, in the extension of that question, if subsidiary is autonomous and only there is a profit sharing arrangement with the parent, then here we will be able to fulfill the conditions of that non-integral foreign operation. So I am doing everything on my own. I have the power to take all the decisions. किसको रखना है, किसको नहीं रखना है, किसको बेचना है, कहाँ से I am to buy the material at what price, who are my customers, I can market my product, I can sell to any customer I want. Then in those cases, it is said that I am not depending on parent. Parent is also not depending on me. Both are independently functioning. Then subsidiary will use that primary indicator and secondary indicator to identify its functional currency, and based on the given facts, it is seen that everything is influenced by US economy. So in this second part, my functional currency for the subsidiary will be US dollar. So I hope you are able to understand. Correct? Now next. Yeah. Now, as I said, once you identify functional currency, then everything is same what we are doing till date. Initial measurement, transaction date exchange rate, average rate allowed for convenience purpose, Here, when you are recognizing any item and converting it into your functional currency, you are not seeing that whether what I have bought is my monetary asset or a liability or non-monetary. Everything at spot rate, right? So this is what we do for initial recognition. Next. Now, what are my monetary assets? Because this again are going to be very important going further. Okay, so monetary assets are what? They are defined as items that will be received in a fixed or determinable amount of cash. That can be cash, cash equivalent, debt securities, accounts receivable. Because I know if I have given you 100 rupees, I am going to exactly get back 100 rupees. That is my monetary item. Determinable, fixed determinable amount of cash, right? Same way, liabilities. Creditors, I know I am to pay them 1 lakh rupees. So exactly I'm going to pay 1 lakh rupees only, right? So payables, bonds, lease payable, exactly I know. Or even for my expenses, I know how much I am going to pay, how much is the bill amount. So that becomes my monetary liabilities. Non-monetary, next. Non-monetary are actually I'm going to use them, I'm going to sell them, and I'm going to realize out of that. So it is not a fixed amount like inventory. I am keeping it to sell in future, right? So that will not be at the same amount. I will be earning profit or maybe incurring loss. So that is not a fixed or determinable amount. So that is example of non-monetary. Same way prepaid, right? I am going to get the services. I am paying that prepaid expense for what? Prepaid insurance, prepaid AMC. I am not expecting that that person has to pay me back the cash. I want the services from that party. So that becomes non-monetary. Equity, again, I am investing to earn something, right? Not fixed. It is volatile. It can go up and go down. So again, it is non-monetary. Investment property, property, plant and equipment, intangible assets. I am going to use them to generate my cash flows. So they are all my non-monetary kind of assets. Non-monetary liability, next. These are deferred income, government grant, because here again, these are my income. I'm not going to pay them back, right? So it is a liability, but non-monetary kind of government grant. I have fulfilled certain conditions. So I'm going to fulfill certain conditions. Because of that, that grant government is doing me. It is not going to take back those funds, right? There will be penalty, but that's why it is a non-monetary liability. Now, this is my most important part, which has actually amended from 1/4/2018, and hopefully you all are doing this only, because if you are not following this, then we are not fulfilling Ind AS 21 requirement. And I would say that it should also equally apply to your IGAP, because these are principal uh, things. These are not like it applies only to Ind AS and not AS. According to me, this is a fundamental understanding of the item, and if it applies to Ind AS, then equally it should apply to AS also. So that's why I thought that this is very important. Advance to supplier, whether monetary asset or a non-monetary asset. Same way, advance from customer, whether monetary liability or non-monetary liability. Here, important thing is that advances you are giving to supplier for what? You don't want that money back, right? You want the goods, and that's why you are paid. So if there is a breach, there will be a forfeiture clause, or there will be a penalty. So that's why such kind of items is a non-monetary item, even though it is advance. Same way, if you have received from customer for advance against goods or contract for which you are to supply goods, then again it is the same thing. He is not expecting money back. He wants goods, right? So it becomes a non-monetary liability. So based on this bifurcation or understanding, how you apply the things will change. That I have taken one more example, so there we will be covering. Now let us actually go faster, because Virag bhai, hello.
Sir, yes,
Virag,
sir.
are you there?
Yes, sir. I'm here only.
Okay. No. Point is this only, that we.
Yes, sir.
Hello.
Yes, sir.
Yeah, we have more 5 minutes, correct?
We have sufficient time, sir. We can extend also if required. There is no issue in
Okay.
that. 10-15 minutes we can
Because
extend also.
that few examples are there, very important. So if you permit, then I will extend for some time if it is okay with all. Fine, no? Okay, fine. So translate to functional currency. So first we have seen how we initially measure, right, at the time of recognition. Now there is a reporting date. So at that time, measure it. So we have seen that at the time of initial recognition, spot rate, exchange rate जो भी था उसके मुताबिक we will actually initially recognize. At that time we will not see whether it is a monetary or non, all items at spot rate, correct? Now in between there is a reporting date आ गया, 31st March आ गया, and my all those assets and liabilities are lying in my financials, which are actually originally foreign currency items, and it is unpaid or unreceived. How I do it? So we have to translate into functional currency, correct? So all monetary items, there I will have to bifurcate between monetary and non-monetary. All my monetary items, I will have to restate it by using the reporting date exchange rate. Okay, and whatever exchange difference comes will go to my P&L. All my non-monetary items, I am not going to restate because those are my non-monetary items. So it will, I do nothing. Whatever initial जो मैंने recognize किया था उसी पे रखूंगा. I will do nothing about that. However, if there is a non-monetary item which actually I may have used for revaluation method, right? Because Ind AS-16 gives me that option. So initially मैंने उसको cost पे लिया था in foreign currency. Then I followed a policy of revaluation. So the standard says, as on the date of revaluation, उसका क्या rate था, exchange rate, that will become the new rate for that non-monetary item which is at fair value. And under Ind AS-16, we have seen that that revaluation, whatever difference comes between the original amount and the revaluation amount, that has to be routed through OCI and shown it as a revaluation reserve, correct? So here the standard says, और जब आपने revalue किया उस दिन का exchange rate और जो original exchange rate था वो दोनों का difference जो भी आएगा, that also you will route it through OCI and it will be parked in your revaluation reserve account. So this is how it has to be done. All monetary items you have to restate, non-monetary items you will not touch, it will remain the same, and whatever exchange difference loss or gain happens, it will be taken to P&L. Next. Now this was actually when we are to transfer to functional currency, any foreign currency translated to functional currency balance sheet, then that was the procedure. However, as we have seen that under Ind AS, you are allowed to present your balance sheet in any other currency also other than functional currency. But you have to follow the translation procedure. You can't directly jump to it. So what is that procedure? In that case, all assets and liabilities has to be restated. So in this case, you are not going to bifurcate between whether it is monetary or non-monetary. All my assets and liabilities, I will use reporting that exchange rate. So उसको मैं सबको apply करूंगा, right? Income and expenses, transaction that exchange rate. However, average rate is permitted. Equity, again, I will not restate. Equity खाली मैं historical रखूंगा. What is equity? Under Ind AS, you have seen under Ind AS-1, equity will be made up of what? My share capital, my all kinds of reserves and surpluses, उसमें मेरा revaluation भी आ गया, सब जितने भी आता है, सोसी में जो भी आता है, that becomes my equity. P&L account, reserves account, and my share capital. All this will be my equity. उसको मैं historical rate पे ही रखूंगा. I will not translate by applying any other exchange rate. So because of this, you will find that there will be a balance sheet will not match. There will be a difference. So that is because I am using some parts को मैं convert कर रहा हूँ, some को मैं original रखता हूँ, किसी को मैं average पे रखता हूँ, right? So because of that, my balance sheet will not match. So that difference we call it as a FCTR, foreign currency translation reserve, and that is to be routed through OCI and taken to FCTR in my equity reserves. It will be there in my balance sheet. उसको मैं reclassify कब करूँगा? जब मैं that उसको बेचूंगा subsidiary को. Okay, till that time it will be part of my FCTR. Now whether FCTR in this case we have seen कि जो भी मेरा balance sheet में difference आया, that is my actually balancing figure. Is it that case, or I can say that whatever FCTR I have got, actually that is the correct one. So उसके लिए it is not a balancing figure. There is a formula. All the equity items, if you multiply by the difference between the closing rate and the historical rate, you will get FCTR. Let us take a few examples. So next one. So as I said, specific steps you need to follow for the translation procedure. So left hand side पे जो है transactions in foreign currency है, सबको पहले आपको functional currency में convert करना है, तो आपका functional currency का balance sheet बन गया, right? And suppose now you want to present that balance sheet which is in your functional currency in some other currency, then you have to follow the translation procedure for presentation currency. Okay, so let us take one example. Case study. Indian company buys a machine for $100 on November 30. Rate of exchange is 1:50. Reporting date is 31st December. On that date, the rate of exchange is 1:40. How you will record the transaction? Here you have to presume that as on 31st December, that creditor is still standing. You have not paid that $100. Okay. So how the balance sheet will look? First, enter the recording date. Next. So on the date of transaction, initial recognition, how will do? I will apply spot rate. So उस वक्त क्या था, 50 रुपीज था रेट मेरा. So मशीनरी को मैंने 50 रुपीज पे फॉरेन करेंसी में से फंक्शन मनी में कन्वर्ट कर दिया. So 5000 came. सामने liability also on initial recognition is at the spot rate. So 50 था, तो liability also 5000. So my transaction उस वक्त क्या था, 5000 दोनों साइड. Now December 31st को when I preparing the balance sheet, उस वक्त I will have to, because I am converting in my functional currency, right? So I will have to use that पहले वाला procedure. I will have to bifurcate between monetary and non-monetary, right? So जो भी monetary है उसको मैं restate करूंगा by using closing rate. Non-monetary item I will not change anything. It will be at historical rate. So machine is my non-monetary asset. So वो मेरा original जो 5000 पे था उसी पे रखूंगा. I will not touch it. However, liability जो मेरा creditor था, that's a monetary item. So all monetary item I will restate. So 31st December का मेरा rate था 40 rupees. So अभी हो गया 4000. So because of that, whatever exchange difference gain or loss comes, that goes to my P&L. So here 1000 rupees is my profit and loss balance. So this is how my balance sheet will look as on 31st December. Now next, suppose keeping everything, now my functional currency is INR. So I have prepared my balance sheet as per INR. Now I want to present it in US dollar. So how the standard says I have to follow. So as we have seen, whenever I have to convert my functional currency balance sheet into presentation currency, I will use what? The translation procedure for presentation currency. उसमें मैं क्या करूँगा? I will not bifurcate between monetary and non-monetary. All my assets and liabilities which is there in my balance sheet, I will use my closing rate. Okay. और फिर जो मेरा इक्विटी रहा उसको मैं हिस्टोरिकल रेट पे रखूंगा, उसको मैं टच नहीं करूंगा. My P&L will be average rate. I think this is how we follow that translation procedure to convert functional currency balance sheet into presentation currency balance sheet. So if I apply that translation procedure, next slide you will find this slide that go back, right? Yes, no, go back. Yeah, this one. So how it looks, because here my I am converting functional currency balance sheet into presentation currency balance sheet. All my assets and liabilities, irrespective of monetary or non-monetary, will be converted into by using closing rate. So मेरा मशीन जो था वो 5000 पे था, उसका क्लोजिंग रेट अभी क्या है 31st का 40, so it gets to 125. Liability 4000 पे था, again I use my closing rate 40, so मेरा 100 आया. P&L जो मेरा 1000 रुपीज है, राइट? इसके पहले वाला बैलेंस शीट हमने देखा, मेरा फंक्शनल करेंसी का बैलेंस शीट में P&L वाज 1000 रुपीज. उसको आई हैव टू यूज एवरेज रेट. So एवरेज रेट क्या है 45. So based on that I am getting what 22 rupees, $22, and the balance now balance sheet tally नहीं हो रहा है. So that balance is what FCTR, that comes to 3. Now whether that $3 is the correct one or not, I will use that formula जो हमने देखा. So FCTR reconciliation is what equity multiplied by difference between closing rate and historical rate. मेरा equity यहाँ पे क्या था, only P&L था 1000 rupees. So 1000 multiplied by 1/40, that is my closing rate, minus 1/45, that is my historical rate for P&L, right? Average rate है हम लोग, तो दोनों का डिफरेंस आप फाइंड करेंगे, we will get $3. So this is how your balance sheet will look if you convert from your functional currency, that was INR balance sheet, to a different currency, that is a presentation currency. In this case it is US dollar. Then you will find the same balance sheet looks like this, because you are applying a different procedure for translation. This is very very important. ये अपना AS गैप में नहीं है, आई गैप में नहीं है, यहाँ पे है. So you have to compulsorily do this. So यहाँ पे important क्या है कि समझो मेरे केस में US डॉलर स्टार्टिंग में मेरा फॉरेन करेंसी है, INR इज माय फंक्शनल करेंसी. अभी वापस में उसको US डॉलर प्रेजेंटेशन करेंसी में कन्वर्ट कर रहा हूँ, राइट? इसका मतलब क्या, US डॉलर मेरा पहले था एज अ फॉरेन करेंसी, तो वही मेरा यहाँ पे प्रेजेंटेशन करेंसी भी है, राइट? इसलिए नहीं कि गो बैक टू दैट, एक बे साइड पाछल जा अजी या. सो हियर इफ यू सी लेफ्ट हैंड साइड तो करेक्ट था, फॉरेन करेंसी US डॉलर है मेरा, उसको मैंने कन्वर्ट किया पहले फंक्शनल करेंसी, दैट इज INR. सो हमने वो बैलेंस शीट देखा जिसमें P&L मेरा 1000 आया, फिर उसको मैंने कन्वर्ट किया प्रेजेंट करने से फॉर इंडेक्स के सपोज US डॉलर, तो उसको हमने देखा FCTR आया $3 का. सो इफ राइट हैंड साइड पे नाउ इफ यू रीड, स्टार्टिंग में क्या है, ट्रांजैक्शन इन प्रेजेंटेशन करेंसी, दैट इज सपोज इन आवर केस इट इज US डॉलर, राइट? वो मेरा फॉरेन करेंसी भी है, और अगेन बिकॉज मैं उसी में कन्वर्ट करना चाहता हूँ बैलेंस शीट को, इन दिस केस इट इज माय प्रेजेंटेशन करेंसी आल्सो. सो आई हैव माय ट्रांजैक्शन इन माय प्रेजेंटेशन करेंसी, so I can directly go to the last slide. All my transaction which is other than my functional currency, first I will have to convert that into my functional currency, and then only I can go to presentation currency. Shortcut नहीं है यहाँ पे. That is what with this example I am able to prove you. There is no shortcut. हमेशा पहले कोई भी ट्रांजैक्शन होगा आपको, फर्स्ट स्टेप इज टू कन्वर्ट एवरीथिंग इनटू योर फंक्शनल करेंसी बाय यूजिंग दैट फंक्शनल करेंसी का ट्रांसलेशन प्रोसीजर, राइट? जहाँ पे मैं मॉनेटरी नॉन मॉनेटरी दोनों देखूंगा. फिर अगर मुझे एक बार वो मेरा फंक्शनल करेंसी का बैलेंस शीट बन गया, जिसमें एज आई सेड एवरीथिंग विल गो टू माय P&L, नथिंग इज FCTR. व्हेनेवर आई डू इट प्रेजेंटेशन करेंसी का बैलेंस शीट, यहाँ पे बिकॉज सर्टन आइटम्स आई एम रीस्टेटिंग एट द क्लोजिंग रेट, बाकी का इक्विटी को मैं हिस्टोरिकल रेट पे रखता हूँ, देयर विल बी अ डिफरेंस इन माय बैलेंस शीट, दैट वी कॉल इट एज अ FCTR, व्हिच आई रूट थ्रू OCI. So there I have to follow that different procedure to convert from functional currency to presentation currency. So यहाँ पे shortcut नहीं है. That's what with this example I wanted to prove. I hope it is clear to you all. So if you understood that presentation currency का translation, no, same applies to your foreign operation. So foreign operation में भी you have to use that presentation currency वाला translation procedure. All assets and liabilities at reporting at exchange rate, income expenses average rate, and equity at historical rate. And the difference in the balance sheet will be FCTR, which you will route through OCI. और जब आप foreign operation को बेचेंगे उस वक्त it will be reclassified to P&L. तब तक it will be lying in FCTR only, right? So now take the example. Next one. Next, yeah. So case study, US dollar. Everything is given in, because this is my foreign subsidiary. The items are in US dollar. If you see, they have given different items: liability, reserves, equity, goodwill, plant and machinery, other assets. So closing rate is 50. Historical of equity is 30. And historical rate for reserves, which is there in my balance sheet, it is 40. Okay. So now I have to convert this US dollar balance sheet to INR for the purpose of consolidation, right? So here I have to use that procedure for presentation currency. जो procedure था वो use करेंगे. तो इसका मतलब क्या हुआ? I will not bifurcate between monetary and non-monetary. All items of my assets and liabilities, I will convert it to using the closing rate, right? So इसलिए आप देखेंगे तो goodwill, plant and machinery, other assets, and that liability, all are my assets and liabilities. उसको मैं पहले closing rate से convert कर दूंगा. Then there are two other items remaining. The one is equity and one is reserve. हमने देखा है कि we will not touch equity and reserves. उसको हम historical rate पे ही रखेंगे. उसको हम restate नहीं करेंगे. So historical rate of equity they have given 30. So 700 जो है equity डॉलर में, उसको मैं 30 apply करूंगा. So I will get equity का answer. Reserves को I will use historical rate given for reserve, that is 40. 100 को 40 से multiply करूंगा. I will get that. And the difference जो balance sheet में आया, that comes to 15,000. So whether that FCTR is correct or not, we can find by using that formula again. Equity multiplied by closing rate minus historical rate. So 700 into 50 minus 30, you get 14,000. And on reserve, it is 100 into 50 minus 40, you get 1,000 rupees. So total 15,000 reconciliation हो गया आपका FCTR का. So now you have converted your foreign operation into INR functional currency of your parent entity for the purpose of consolidation. This is how you will do it in real life. And one more thing here it will come, which I have not covered because that comes under Ind AS-12. I think hopefully you are going to cover it tomorrow, day after tomorrow. There, for this type of FCTR, there will be a deferred tax liability, which also will have to be provided when you make the consolidation with your parent. That I think that speaker will be covering on FCTR, that deferred tax liability will come. So on this 15,000, whatever rate of tax which is applicable, whether it is by of dividend or long-term, short-term capital gain, whatever rate under income tax is applicable for this type of transaction, at that rate you will have to create DTL in this case, because there is a positive reason. That hopefully that speaker will cover, but you have to keep in mind DTL will come here. Now next one, three items more. Then I think we have only one that advances का related 3 मैंने case study दिया है. So answer भी साथ में है. So we will be just have a look and then you can go through. If any queries tomorrow also you can ask me. We can clear it out. Don't worry. In this quiz, which of the this consideration would not be relevant in determining the entity's functional currency? So A, B, and D, if you see, those are all relevant factors. C is the only factor which is not relevant, because I don't go by whether it is a financial stable currency or not, right? That is not the consideration. So answer is C. Next, quiz 2. Monetary items, yes, I restate. Non-monetary item, I don't restate, right, at the reporting date. for fair value I restate at the date of that fair valuation, not at the reporting date. So answer A is the answer. 1 is true, 2 is false. Third quiz, seasonal pattern of income and expenditure. So standard is very clear that either there is a seasonal pattern or there is a huge fluctuation in that rates, then you cannot use average rate or monthly average or year-end spot rate. You will have to go by historical exchange rates on the date of individual transaction, right? So C is the answer here. Next. So as far as my presentation on Ind AS-21 is concerned, this is all for that. However, as I said, on that advance received and advance given type का जो transaction है, where I said that there is a fundamental difference in how we will be dealing in real life. For that, I have taken 2 examples. So Naikit, I would ask you to go through that. Bring it on the screen. Yeah. So hopefully you are able to view it properly. So in this case, first case study is actually, see the answers are also there. So what I will do, Naikit, you can actually mail this also to them, right? After the presentation is over, so that they can have a look at the answers. And then if they have any doubts, we can discuss tomorrow also. So in this case, what I have done, first case study is relating to actually Indian entity is importing a machinery. For that, Indian company is making advance payment to the supplier in dollars, and in the as far as the milestones are reached, so different milestones are given, and that $10,000 have been paid out of the total contract of $50,000, different dates. Okay, and then in between there is a reporting that also comes. Then after the reporting that, actual import happens, and after that import, after 15 days, the balance whatever was due has been paid, and that's how the account gets settled. So in this case, applying that, now we know that advance is paid to supplier or advance is issued from customer is a non-monetary item and not a monetary item. Then how we apply these principles given in Ind AS-21, and as I said, from 1/4/2018, standard has been changed, and there is a specific appendix for this, dealing with this, and based on that, I have prepared this question. So how it will look? Answer is given. Niche here, right? Okay. So if you see, up to 31st March 2019, various dates, whenever I have made the payment to that supplier, I have used that exchange rate of that date, and I have paid the bank. So entry is coming on 1st October, suppose to bank 6 lakhs. Then on 15th, that rate is somewhere 63. So $10,000 into 63. So it comes to 6,30,000. On 15th, I have made the third installment. At that time, rate was 66. So 10,000 into 66, it comes to 6,60,000. Now, 31st March को मेरा reporting date है, and because these are non-monetary items, I will not restate them, right? So 31st March को मैंने restate नहीं किया उसको मैंने वैसे ही रखा, तो मेरा closing balance आया, advance given to ABC 18,90,000 rupees. There is no exchange difference on that because restatement नहीं हुआ, because these are my non-monetary items. Machinery आया हुआ नहीं है, so machinery में भी nil है. Now next year में 1st April को I will brought forward that balances. So ABC में मेरा 18,90,000 मैंने carry forward कर लिया और brought forward हो गया. 15 April को मैंने I received the machinery, so I will recognize the machinery, right? So उसमें क्या करूंगा मैं entry? Here the standard says जो भी आपने ऑलरेडी पेमेंट कर दिया था because they are नॉन मॉनेटरी आइटम्स, उसका आपका रिस्क ऑलरेडी खत्म हो गया है. You don't have any exchange difference risk on that item, already it is paid. So because of fluctuation in exchange difference, आपका आंसर चेंज नहीं होने वाला है. You already have incurred those $30,000 paid, right? So 18,90,000 आपका freeze हो गया है, which has no risk as far as exchange difference is concerned. तो उसी को आप ऐड करोगे, किस पे ऐड करोगे? Whatever is left, $20,000, right? टोटल 50 था, मेरा मशीनरी $50,000 का मुझे इनवॉइस आया रहेगा ऑन 15 अप्रैल. उसमें से मैंने 30,000 ऑलरेडी हैव पेड. सो हाउ मच इज लेफ्ट? $20,000. सो ओनली दैट $20,000 को मैं रिकॉग्निशन के वक्त 15 अप्रैल का जो रेट रहेगा उसको मैं $20,000 से मल्टीप्लाई करूंगा, राइट? सो इट कम्स टू 13,40,000. I will add already paid that $30,000, that is 18,90,000. दोनों का मुझे टोटल आ गया, सॉरी ये मेरा 13,60,000 आया, राइट? ऑन दैट 15/4 का एक्सचेंज डिफरेंस लूंगा तो. सो दोनों का मेरा टोटल आएगा 18,90,000 प्लस 13,60,000, दैट कम्स टू 32,50,000. दैट इज द अमाउंट एट विच आई विल रिकॉग्नाइज मशीनरी इन द बुक्स. ओके, तब तक मेरा कोई एक्सचेंज डिफरेंस नहीं आया. Now on 30th April I am paying that balance 20,000, right? तो उसमें मेरा exchange difference आएगा because on 15th April when I recognize my machinery, actually मेरा creditor first time that payable came into my books. तब तक तो क्या था? It was advance, and advance was my non-monetary item. Now 15th को जैसे ही मैंने वो एंट्री पास किया मशीनरी का, एबीसी बिकेम माय क्रेडिटर बिकॉज उसको अभी मुझे $20,000 पे करने का बाकी है, राइट? सो दैट डे उसका कलर चेंज हो गया. एबीसी इनकॉर्पोरेशन जो पहले एडवांस था 15th अप्रैल को, इट चेंज इट्स कलर एंड नाउ इट बिकम अ क्रेडिटर, एंड दैट क्रेडिटर इज नाउ कंसिडर्ड एज अ मॉनिटरी आइटम, जिसके ऊपर अभी एक्सचेंज डिफरेंस आई विल हैव टू रिकॉग्नाइज. सो उसका जो लायबिलिटी था मुझे पेएबल एज ऑन 15th अप्रैल व्हेन आई पास दैट मशीनरी का एंट्री, ड्यू वाज 13,60,000 रुपीस, जो $20,000 था. एक्सचेंज अभी 30th अप्रैल को मैंने पेमेंट किया, उस दिन एक्चुअली देयर इज अ फेवरेबल एक्सचेंज डिफरेंस, राइट? सो उसकी वजह से 20,000 I saved, ₹1 का फर्क है. So actually I paid 13,40,000 and 20,000 I saved on that. That is my exchange difference. So उस वक्त मेरा exchange difference first time मेरे books में आया. So based on this example, you will see that exchange difference मेरा कब आता है? जब actually that item becomes my monetary item. Till that time जो भी मेरा advances था उसको मैं वैसे का वैसा ही add करूंगा to recognize as asset or a liability in my books. This is the basic difference between जो पहले हम यूज करते थे और अभी after 1/4/2018 we are using this. And according to me, same should apply for your IGAP also. There should not be any difference because this is a principal clarification, right? So ऐसा नहीं है कि मेरा monetary item जो IGAP में है तो मेरा Ind AS में it should be some different because this is a principal. Principal तो same ही रहेगा ना. Here principal is what? मेरा risk है कि नहीं है. If there is no risk I am carrying, then it's a non-monetary item for me. There is no risk. Risk कब आया? जब मेरा उसका liability हो गया. उसके बाद fluctuation will impact me. Till that time तो मेरा 18,90,000 मैंने दे दिया, तो that was all, right? This is how it has to be seen. So second example, if you see, that is उल्टा export का है. पहला import था, second is export. So I would like that you all actually solve this example. Answer भी मैंने दिया है. So I think Naikit will be sharing with you through Virat. So he will send you. Okay. And the third question, case study, is actually conversion into presentation currency. मेरा जो थर्ड क्वेश्चन मैंने केस स्टडी लिया है उसको आपको स्विस फ्रैंक जो मेरा फंक्शनल करेंसी है वो बैलेंस शीट को आपको प्रेजेंटेशन करेंसी दैट इज यूएस डॉलर में कन्वर्ट करना है बाय अप्लाइंग जो हमारा प्रेजेंटेशन करेंसी का मैंने जो आपको आज अपना वी हैव कवर्ड नो that उसका भी यहाँ पे आंसर दिया हुआ है. So I would like that case study 2 and case study 3 all of you actually try to solve. आंसर भले इसके साथ है आपके पास, but you try to solve independently so that the principles which we have actually dealt with today will be very clear in your mind actually when you actually in your real life you utilize these principles. That's the purpose why I have given these 3 case studies. So that's all for from my side for today's thing. I think I have overshot by 25 minutes, but I think it was required as far as I thought. Okay, thank you. Virag bhai.
Yeah, thank you so much, sir, for wonderful presentation. I already received a few feedback on my personal chat on WhatsApp, and so would like to say thank you on behalf of all the participants, sir. Thank you to you and obviously your team, sir. He is also having a moving slide from operation that this slide. So thank you both, you and your colleagues, sir. Thank you so much. And we are in webinar right away here, sir. Tomorrow we will meet at 6 o'clock. Thank you so much.
Thank you everybody. Thank you. Okay, sir.